So they offer investors a contemporary, full-service approach to build and manage their investments, providing investment-related products, services, and sophisticated financial planning that combine the best of what people and technology have to offer. They are a multinational financial services company that offers banking, commercial banking, and a trading platform and wealth management advisory services. So without further ado, I'm going to go ahead and introduce our panelists for this evening. They will each tell us a little bit about themselves, and then we're going to get started. So we have Rudy St. Cyr, Geraldine Ortiz, and Hayden Adams. If you all can go in that order, if you can just give us a quick overview about yourself, and then we will get started with Q&A.
Great. Thank you, Kimberly. First of all, I want to definitely thank the National Black MBA for putting on the event, and commend everyone taking time out to invest their time and hearing about investing with Charles Schwab. I'm Rudy St. Cyr. I'm a private client advisor at Charles Schwab. I've been in the business for over 27 years. I work in our premier wealth management registered investment advisory arm of Charles Schwab. We're responsible for over $150 billion of clients' assets. We are the largest registered investment advisory firm in the nation. My team, we work in Pennsylvania. My team handles over $2.6 billion of client assets, and personally, I manage over $600 million of client assets. So primarily do investing, financial planning, the whole ball of wax. I'll turn it on over to Geraldine.
Thank you so much, Rudy. I appreciate it. So again, my name is Geraldine Ortiz. Thank you so much for having me. I am the Vice President of Tax Information Policy and Compliance. Now that's a really big mouthful. So basically I'm the tax executive that provides guidance on client and employee matters from a tax perspective for Schwab and all of its affiliates. So we address regulatory changes, any new laws that come out, as well as any large client escalations, probably some of Rudy's clients, but they never have problems. So my background is I've been in actually the reporting compliance area for about 25 years. I've been with Schwab about 8. Formerly with TIA Craft. I spent about 19 years there, where I had held various positions, mostly and tax operations, where I was actually the head of the tax operations team. My education is pretty broad. I love to learn, so I have a JD. I also have a master's in tax law that's focused on tax planning, and various other certificates to boot. Participate on industry panels, and I'll turn it over to Hayden from there.
Thanks, Geraldine. So I'm the Director of Tax and Financial Planning for Charles Schwab. So basically, I write articles on tax planning, talk about various tax planning topics, and from whether it's like how to save efficiently for retirement, how to take tax efficient withdrawals during your retirement. I'm a certified public accountant, certified financial planner. And the one that seems to interest people the most is I'm a former IRS agent who specialized in high net worth individuals and people who owned closely held businesses. So like I audited people who owned football teams for fun, stuff like that. So I take that background and I apply it to our clients and talk to them about ways in order to help reduce their tax bill without getting in trouble with the IRS.
All right, thank you. Well, we have the right one today. So, and former IRS agent. So please, if you all have any issues, any darts to throw, Hayden's on the call. We can go after him. So thank you all so much for those introductions. So again, for those of you that are just joining us, thank you for joining us again this evening. So just a recap of last week. This is our 3-part series, and we are talking about the comprehensive financial planning process. And we just wanted to go beyond the basics of, finances, right? It's Financial Literacy Month, but we wanted to bring to you all a platform where we can go a little bit beyond that, right? So it's also about financial literacy, but it's also about having access to the resources, right, to get us to where we need to be. So last week we talked about what is comprehensive financial planning. We also talked about debt and cash flow management and risk management, right, as being the foundations of the planning process. So now we're moving into the next few areas. So we have investment planning this evening, we have educational planning, and then we also have the dreaded tax planning, right, which, you know, can be fun at the same time. So what I'm going to do is just a question. It's kind of about 3 parts here. So I think Rudy's gonna talk about the investment educational component. Geraldine and Hayden, you all will tag team on tax planning, but also hit on, right, how it ties in to the whole gamut there. The last 12 months have, for the lack of other colorful words, have been on fire, right? When we think about markets. Unfortunately, we know that, you know, some people have had to halt their investing strategies. On the opposite side of that, there are some people that have, you know, still maintained their income levels where they were able to either start their investment strategies or investment planning. And then there's some that have really accelerated this component of their financial career, financial lives. So if you could just kind of hit on those 3 type of persons, right? Because we probably have all different situations on the call tonight. So for someone that has had to maybe halt their investment strategies, for someone that's new in investments, maybe they have gotten their basics under control, their cash flow, and they want to start an investment strategy. And also for those that are taking it to the next level, that want to accelerate, you know, this aspect. What are some things that all 3 of those type of persons should consider? What's the next step for them?
I think regardless of where they're at in their financial, I guess, maturation, so to speak, the key for any investor out there is to have a financial plan. I think once you have a financial plan with some specific goals, what you're looking to accomplish, regardless of what's transpiring in your life, in the sense of whether it's job loss or you know, just starting out, you could actually stay true to that plan because you know what that end goal is. So once you start that, you have that financial plan, set up some realistic goals on what's going on, where you want to actually go. I think that's critical there. If you're new to your job or just getting involved into the market, I think the key I like to tell all investors is just get started. You know, you cannot time the market because you'll turn on the news and you hear different publications or different talking heads saying the market is too high, it's going to pull back. The key is to get started because we're not sure exactly when the market will actually pull back. And the critical thing is if you have, let's say, 10 or 15 years, getting that money engaged into the market, you're going to do far better off than trying to wait for that perfect time to get into the stock market. And I think the other key thing you want to actually do is once you actually get involved in the market is make sure that your portfolio is actually diversified. So you're not buying into just large cap stocks or small caps or international. You make sure that your portfolio is diversified through different asset classes and different sectors. The way I like to look at it is in a sense of diversification, break it down real simple. If you're on a highway and you're in the middle lane, what happens? You're stuck in the middle lane. You look to the right, the car in the right lanes, they're flying past. So what do? You jump into the right lane. And as soon as you jump into the right lane, what happens? The car stops and the car that was behind you in the middle lane actually goes past you. So the way I look at investing, we want to make sure that you have your assets covering all the lanes in the highway. So it doesn't matter if large caps are doing well, small caps, international bonds, you have representation within all lanes of the highway, and you can actually take advantage of that. And then you'll minimize a lot of risk that you'll take on trying to invest looking in the rearview mirror saying, hey, I heard large caps are doing well, let me jump into that. And next year, small caps may do well. So we just want to make sure that portfolio is diversified. And I think the key also for anyone looking to invest is to minimize fees and look at taxes. We have to pay taxes to Uncle Sam. I tell clients all the time, I want to be tax minded. I want to pay our share of taxes, but we don't need to pay more than we need to Uncle Sam. That's the key. And Hayden will, and Geraldine will definitely give us an insight on the sense of how we can be tax efficient overall with our investing. So those are some few tips that I have.
Excellent. And I like how you said it's always coming back to have a financial plan completed, regardless of whatever phase you're in, right? If things change, have it updated, right? Have it modified based on, the new situations. And one thing I wanted to, talk about as well is that when people think of, investment planning, it may not always be about the market, but that's what a financial plan does. It should bring everything that you're investing in to give you one picture that you can see in one sound place. Some people like to talk about, the stock market, right? The stocks, bonds that they have, but then they may have, let's say, real assets like real estate, on the side, but a financial plan should bring that all together. So can you talk a little bit about how you look at not just, market assets, but other assets within their plan and how that ties?
Yep. So I think the key is we have the financial plan and we have the full-blown comprehensive plan. I think the full-blown comprehensive plan is what you're talking about in the sense of, I think all individuals need to have that because there's other areas in the market or other areas in your life that you need to actually look at. You have the estate plan. You have to make sure you have proper insurance, especially if you're the main breadwinner for your family. What happens if you decease? Will your child or your household be disrupted? So you definitely want to look at that. Like I said, estate planning, you want to make sure that you have the proper insurance on your cars, liability insurance. So by us looking at a comprehensive financial plan, what we'll look at and say, hey, there may be some areas where we may want to cut back on investing or areas of focus where we may want to look at adding more funds into or take advantage of rather than focusing on the overall stock market.
Geraldine, Hayden, would you all like to add anything to what Rudy has said with regards to investing?
I'll let Geraldine jump in first.
Okay, sure. So yes, I definitely agree. You have to have a diversified portfolio. There are many ways to invest. But I have to say that when I think about it, I'm thinking about it from an overall tax funds and retirement spending. I kind of try to make it simple and look at how am I going to meet my retirement goals and how am I going to, whatever planning goals I have, how am I going to meet them and assess the taxes? So, crypto's been big lately, and that's not, in the typical investment world. There's all kinds of things out there, real estate to invest in. So there's so many things we can talk about, but I'll turn it over to Hayden, and I'm sure there'll be lots of questions.
Well, let me see if I can share my screen here, if it's going to let me. Yeah, it's going to let me. Okay. So hopefully everybody can see this. This is a little diagram I like to share when I'm doing presentations. It basically shows how I envision tax planning. Tax is never the primary reason I think anybody should do anything. Like you shouldn't be like trading your account to avoid taxes or anything like that, but tax impacts your entire life cycle. And that's what this chart here is really kind of showing, is that through your entire life cycle, from when you're saving to when you're investing that money and having it grow to when you distribute that money either in retirement or at death, taxes will impact you. And so they're a key aspect of every decision you make when it comes to your investment decisions. And the one thing I always tell people is like, hey, I know the urge is there. You want to click that button, make the trade. Don't. Stop, think for a minute and say, okay, what are the tax implications of this? Because there's lots of things you can do trading wise. You can sell the asset with the lowest cost basis, which means you're going to recognize the biggest gain. And depending on your situation, that may not be what you want to do. So every little decision, definitely think about the tax aspects of it. And one thing that I kind of wanted to touch on for that question you asked Rudy earlier on is that, like, what about people who are just starting out versus people who are like later in life and maybe trying to max out their retirement savings and stuff like that. The way I see retirement savings is that first and foremost, you want to max out those tax advantaged accounts like your IRA, 401k, Roth accounts, things of that nature. And one of the biggest questions I get is, well, which account do I give to? Well, in general, like your life cycle kind of follows a path. And so like you start out usually in your career, like In my career, I started out not making very much, you know, and as I progressed in my career, I moved up and up and up, and I'm in my mid 40s now, and probably about the time I'm in my mid 50s, I'll reach my peak earning potential. And so if you look at it that way, what you can say is like, okay, when I'm younger, I'm in a very low tax bracket. So in that sense, maybe a Roth account is what makes the most sense, because I'm not paying much taxes today. So getting a tax deferral from like a 401k or a traditional IRA is not going to benefit me except for to the tune of like whatever 10, 12% tax rate I'm in. So a Roth can make a lot of sense when you're younger or when you're in a lower income tax bracket. Then when you get into the middle age, like where I'm at, you know, you're kind of in a middle tax bracket. So it's like, well, which one should I be? Am I going to be in a higher tax bracket when I'm in retirement, or I'm going to be in a lower one? Well, I don't know. It could be either. So for me, like splitting between the two accounts can make a lot of sense. I contribute some to a Roth, and you know, we've got Roth 401k, so I can contribute some to a Roth 401k, some to my traditional 401k, get that match. And then after I've maxed those out, if I have some money left over, then I can maybe start considering saving in my taxable brokerage account. And then finally, if you're like at that max earning potential, you're at the peak of your career, or your career is about to end, that's where deferring as much as you possibly can make the most sense, because at that point, you're probably in the highest tax bracket you're ever going to be in your life. Generally speaking, people's tax bracket goes up, then they go into retirement and it drops a little, and then it kind of flattens out for the rest of your life. So that's one of the ways that I think about tax planning, is that it's an overall life cycle. You think about it in every stage of planning. It's something to think about, but it's never the primary focus for anything, because it's like someone like Rudy, he's going to help you guide people through that process of like picking the right investments, picking the right risk tolerance. Those, I mean, all these things, diversification, those things are incredibly important. And then taxes is just one of those things that we always have to think about.
Yep, and just to add on to that, so when you're thinking about an overall tax planning perspective, I worry that sometimes people just feel like they're going to roll the dice and they're just going to kind of see where they land out. So I actually came up with something. I need things to help me remember. So I called it, so my term is DICE. So what does DICE mean? So DICE, I think about, okay, you know, back to what Hayden was saying, what can you put pre-tax? What can you defer, right? What can you take out of your taxable income? Then the next I, itemization. How can I make the most of my itemizations? How can I, you know, am I getting all the charity deductions I can? You know, maybe what is a different way of doing it? You know, what other ideas are there? You know, one of the things that I've seen, you know, from a charity perspective, you know, there are a lot of good charities, and, you know, I'm going to just emphasize that because I know a lot of charities are hurting right now. You know, you have a vacation house. Donate a week of your vacation house to the charity, and if it's a publicly traded charity, they'll usually give you big fair market value of that rental. You know, losses, right? From an investment perspective, what losses can you harvest because maybe you have an underperforming stock or you have an underperforming asset, you know, and don't forget credits, of course, you know, that's important. You know, you'll get dollar for dollar match on that. When I'm looking at C, in my kind of dice analogy, I think about, you know, how do you change your tax liability, right? Is there a way you can shift income from one year to another? You know, is there, you know, let's say you have this highly appreciated stock and you have to pay for your kids' college and they're over 18. Well, maybe you want to gift that stock to your child, you know, it's just, you know, maybe, and have them actually do the sale. You know, there are different ways to actually be able to change things, and it's, you know, again, disclaimer, based on your tax situation. There's so many things that really go into your tax perspective. And when I look at E, I think, okay, estimate your tax liability. This is something that I do on a regular basis, and I've been in tax for years. I mean, the IRS has a really good calculator out on their website, and that actually, especially if you're a W-2 employee, is really helpful because you can actually adjust your tax withholding to what the withholding calculator states, and it'll let you do it based on, you know, how, you know, the frequency of your paycheck, etc. So that's just, you know, one way, I think, an easy way to actually think about tax planning. And again, not just roll the dice and just figure that the chips will fall where they do.
Awesome, thank you. Can you repeat the C again, please?
Sure. So I said change your tax liability. So change it to a different tax year, change it to a different person, again, that 18-year-old who needs to pay for their student tuition bill. So, there are different ways to fund education. Again, happy to talk about that later.
Awesome, thank you. I like acronyms, they're easy to remember. Okay, thank you so much to the three of you for that. So one of the things that was mentioned was a couple of terms is risk tolerance, right? And so I will say this because I've just in conversations with people and things like that. So we can read textbooks, right? The textbooks usually say the younger you are, the more aggressive you should be. And then the older you are, closer to retirement, the more conservative you should be, right? Can you speak a little bit about just a little bit about what risk tolerance is, and then also talk about does that work always as far as if you're younger, more aggressive, if you're older, more conservative, or do you oftentimes see people kind of go against the grain or go against what the textbook says? Another thing to that, if you'd like to touch on this, is I know sometimes in our community, and I'm talking about particularly African-American and other minority communities, at least, from what I've seen and had conversations, is that people are sometimes skeptical, right? We're a little scared or fearful, particularly when things happen like 2008, 2009, and then of course, March of last year, we panic. And so we sometimes get to the point where we want to just, I just want to be safe, this money, I really don't want to take that chance. So can you just talk a little bit about, the psychological aspects and how we kind of overcome that with conversation?
Sure. So the risk tolerance, I think when you look at risk tolerance, it's pretty much your stomach for handling volatility or pullback within an investment. And like you said, the textbooks have, you're young, you should be overly aggressive. You're older, you're retired, you should be ultra conservative. And I like to preface it depends on the individual. It's customized in the sense of, yes, if you're young, you can take on a little bit more risk because you have a longer time horizon in a sense of needing those funds. But I tell clients all the time, if you're losing sleep overnight, tossing and turning, that means the risk tolerance that you have is a little bit too aggressive for you. And we need to customize that in the sense of how you want to do that, in the sense of some people can't take that volatility. The market pulling back in March 35% is huge in the sense of some people wanted to sell out and just put everything on the sidelines and not get back in. But at that point, I'm saying, hey, you're a little bit too risky, because when the market is doing well, there's a tremendous euphoria where everybody wants to get in. I want to buy right now. The market's higher and higher. Yes, keep putting in, add more. I want more stocks. But on the other side, when it's going down, all of a sudden you want to be ultra conservative and sell out of it. So I definitely say, it depends on the individual investor. You have to customize their risk tolerance for them. There's not a blanket approach in the sense of you're 25, you should be 60-40 or 80-20. There's no blanket. It's really personal. And I think also the misnomer that you're looking at is when you retire, you should get ultra conservative. You retire at 65, you should have maybe 20% in stocks and then 80% in bonds. Now, wait a minute, people are living longer now. So you may have a 20-year time horizon. So you need to make sure that money is growing and keeping up with inflation. So you cannot have ultra conservative. So it's more of that balancing act in the sense of the risk tolerance for the individual. And the sense of talking about the community, whether it's other minorities, African Americans, Latinos, in the sense of concerned about investing in the overall markets. I think it's just a cultural effect because it's something that we're not used to. It's hard to understand purchasing an intangible. We're so used to real estate. I could see the land, I could see the house, and we've never been educated in the sense of how the intangible or investing in the stock market. And it just comes through education and understanding what you're investing in. Like when the market pulled back in March, people are really concerned about that. And I tell people all the time, let's take a step back. Look at the situation that happened in March. We put the economy in a medically induced coma. There's nothing fundamentally wrong with the companies that you have. There's nothing wrong with Apple stock the day before the market went down 35%. Nothing fundamentally wrong, but because of the way the market shift, you need to take a step back and reassess. Okay, what happened? It's interesting that stocks are the only things that go on sale that people don't want to buy. My wife, she goes to Macy's, she's looking at a pair of shoes that cost $100. The next day, the same exact shoe is $50. She comes back with 3 pairs and says, dear, I saved us $150. I don't understand. It's the same exact thing with stocks. And if you understand what you're investing in, and you understand where it's going and the outlook, you could be comfortable to stay engaged in that investment because you know eventually it'll come back. Now, if you get into something that you're not too knowledgeable about, like Geraldine talked about cryptocurrency, there's a big buzz about cryptocurrency. If you don't understand how it works, the intricacies of it, that's going to make you even more nervous because I mean, I've been in the business 27 years. I still don't understand how crypto works. And it's being the fact that it's not regulated by the federal government, that's another concern that I have there. So sometimes investors look at the hottest stock or the hottest trend and want to jump into that, not knowing exactly what they're invested in. So I figure the best thing for the minority communities that haven't really gotten involved in investing is just to learn more about it, dip your toe in it. You know, the easiest way to get involved in investing is your 401k, where a company says, hey, you put $1 in, I give you 50% on every dollar up to a certain amount. You just made a 50% gain by investing. And most people are not taking advantage of that. So I think it's just more that educational piece on that.
Awesome, thank you.
Yeah, I'm sorry. I just want to echo what Rudy was talking about. So yeah, absolutely right. A risk is definitely a personal thing, right? And I even look at, Hayden and myself, we had this discussion the other day, the way we were brought up, we both have 2 different risk profiles. He's, I would say that Hayden's definitely much more conservative than I am. And I grew up from a background that, we were lucky to have a checking account with with some extra in it. So, so definitely agree the research, and especially in this day and age, the research is so important. And last comment is never leave money on the table. What Rudy said, if you have, an employer that's giving you money, don't let it go. Just take it.
Yeah, and I'd like to add a little bit to that it's like, I see a lot of people who feel bad about well, I'm not very risk tolerant, and they almost feel like they should apologize because they're not, risk takers, right? Trust me, I'm not a risk taker. I grew up, my dad was a business owner, and so it was kind of feast or famine. And when I say famine, I mean bankruptcy twice while I was growing up, and food stamps, at one point when I was a kid, and that really affected me. And it affected my sister too. We both grew up, became CPAs because we were like, we got to be good at money because my parents weren't, and but we're still very conservative. I probably have 1/3 of my money in cash or cash equivalents. And some people would look at me and be like, that's insane. You should be putting that in the stock market. But by having that much cash laying around, it keeps me in the stock market because I can sleep at night, like Rudy was saying. I'm like, okay, the market's going crazy. It doesn't matter. I've got cash set aside that if there's any problems, I'm safe. And so for me, I'm incredibly risk averse. And my wife is just naturally by her own nature. And one of the things that, like Rudy mentioned, that I kind of wanted to talk about is my wife was very concerned about getting into the market and when should I get in? And one of the reps, I have my own personal financial planner at Schwab. We have financial planners who service the employees. And I like having an extra planner for myself, even though I am a financial planner, because that person looks over my shoulder, guides me through the process, and is a voice of reason to me. And he pulled out this one chart and he showed it to my wife and he said, look, here's the stock market over the last 30 years. And if you invested at every one of the worst times, here's how much money you would have. And my wife was just dumbfounded. She was like, really? Even if I put the money in at the worst, at every single high in the stock market, I'd still be better off than if I had cash. Now, it didn't cause us to take all our cash and throw it into the stock market, but it did cause us to say, okay, it doesn't matter. We're going to use dollar cost averaging. We're going to keep putting our money in the market. We're going to keep investing. but only that portion that, you know, matches our own personal risk tolerance. So don't feel bad if you're you know, like concerned about the market, because I'm looking at the stock market breaking new highs, and I'm not thinking, oh, this is super exciting. I'm thinking this has got to end sometime, you know.
Awesome. Thank you all so much for those answers. And you're absolutely right? Because, you know, we talk to peers, we talk to friends, family members, and, you know, they're talking about how much they made on this cryptocurrency or this stock. And, you know, in the matter of 2 weeks, and people are like, okay, well, I want to get in, but they have no clue, you know, what they're doing. All we're just going by is what someone else has done. And we think that, you know, that would be appropriate for us. So I just want to take a moment just to say, for anyone that's on the call, feel welcome to raise your hand, put a question in the chat box. We do want to make sure if you have any questions that's swirling around your brain, that it gets asked so that we can, you know, have the panelists answer your question. So if anyone has a question right now on investment planning, educational planning, or tax planning, feel welcome to raise your hand. We will acknowledge you, or if you want to type it into the chat box. And while we're doing that, I'll go on to the next question. So I saw your recent earnings report for Schwab, right? And it looks like there were 3.2 million additional retail broker accounts added for the first quarter of this year, which is amazing. I think that they had mentioned that it was more than all of 2020. Is that correct? The new accounts that were added. So what have you all found, or what are you hearing that this is attributed to? And what types of accounts are these new users opening up? Are there trends that you're seeing?
I think it's attributing, I think, you know, Schwab's brand name is so strong in the industry, in the sense of the way we market our services and the help and guidance that we offer, and we educate clients so well. I think that really worked well in the sense of to gather assets, and even have clients consolidate assets to Schwab. I mean, if you think about the plethora of services that we have Schwab Private Client, you know, where myself and my other peers, we manage clients' assets. And then we have our front line on the 4,000 line, where they just do trades all day and help and guide clients. And we have so much tools to help them be so self-directed, but also educated, like we talk about their community, in the sense of, you know, how do I open up a IRA account, all right? How do I plan for college? I think that's really what, you know, goes a long way in the sense of to gather more assets. And even when in times of uncertainty, you know, we don't take on a lot of risk. Kind of like Hayden says, you know, we're an ultra conservative firm. When we had the financial meltdown back in 2008, I believe it was, where all the other firms, you had Goldman, you had Merrill Lynch, you had all the big Wall Street firms taking TARP from the government. Schwab did not take any whatsoever because of our conservative nature in the sense of our investing. And we also share that philosophy with our clients and saying, look, we're not going to tell you what the hot stock of the week is. What we're going to tell you is our true investment philosophy, in the sense that if you have a diversified portfolio, you stick with your plan, eventually you'll achieve your ultimate goal. The same message that we actually do ourselves as a financial firm is what we share with clients, and clients see that in a sense of, you know, well, Schwab is doing right, and we're really championing our clients. I think that really would help bring a lot more assets to the firm overall.
Awesome, thank you. And you mentioned college savings plans. So along with that, there was a question in the chat box. So let's talk a little bit about college savings plans, the 529 plans. The question was, are those plans the only recommended plans for education savings? So I'll just add another caveat to that, since we're on that topic. So if you can just a brief overview of what 529 plans are, the tax implications of them, or the tax advantages of having them. And also if you can talk about other plans for those that have children that would like to, you know, put some money aside, whether it be like UTMA or UGMA account. So that way they're familiar with all of those areas. So all three of you can kind of hit on that, just in general what they are, and then talk about the tax advantages of them.
Okay. I could hit the plans, and I'll defer to the tax guru on the tax benefits of them. But like anything else, there's not one true investment plan in the sense of for college savings. They all have their pros and cons. Like the 529 is the most popular, where you actually there's no annual contribution limits. The owner still retains control of the assets for the child, and then also that one thing is that they have like preset portfolios, so you can't really have a lot of flexibility in the sense of what type of investments you actually want to invest in. So some clients prefer 529s. You also have the college savings account. That one has a little bit more flexibility, but the maximum you could actually contribute into that is around $2,000 a year. So you're not going to put a stockpile a lot away. And then also you mentioned the UGMA or the UPMA accounts, which is a custodial account. So there's no limited amount of assets that you could actually put into it. Yes, there's gift taxes laws and everything like that Hayden and Geraldine will actually get into. But I think the key when you look at college savings is that, okay, how much control do you want to have for the assets? The two accounts is the college savings account, the educational savings account, and the 529s, where those are primarily for college or higher or education or schooling or higher education. The UGMA accounts, pretty much that is just a holding account where you're the custodian and it's really the asset of the minor. So once the child or the minor hits the age of majority, whether it's 18 or 21, that's their assets. They don't have to go to college with that. So just imagine, I know myself at the age of 18, if I had $20,000 in a UGMA account or a custodial account, I would have went out and bought a car. I would probably went on a trip. I would have blew that money. I would not have gone to college, and my parents would have no control whatsoever for that. But with the 529 and the educational savings account, there's a little more restriction that you could actually look at doing. And then the other piece, you want to look at financial aid. How much of that is actually going to affect the child's financial aid. So there's a lot of planning that you can actually go into in the sense of how you want to actually do any type of college saving. But the tax part, I'll defer to the tax gurus, Geraldine and Hayden, on those.
So Rudy, very well said. So I would say it really depends on, the mix that you're looking for. And your child and who you're saving for college, right? And really, again, your tax perspective. So I'll just give a personal example. So I'm actually using a mixture of products. So I am using a 529. My son is in tech, so I expect that he will go to college. However, I've been hearing recently that some for tech, they're actually hiring people right out of high school, and they're actually training them. So what I decided to do was put some money in a 529. I actually have some money that I'm making backdoor contributions into a Roth, because again, don't know what I'm going to use. And I gave him, a small amount in an UTMA that I've been actually putting some money to in a custodial account. I'm also helping try to save for my niece. So again, for her, I have, again, 2 accounts because, again, she's only 7, so she really doesn't know what she wants to do. So again, really depends on, what are you planning for? Are you planning for a state school? Are you planning for a private school? And then, how much are you going to save on your taxes? Because when you really think about it, in a 529, while some states allow you to take a deduction, there's no federal deduction. So you're basically putting it in, your earnings will go tax-free, and you hope over the time span that it'll be much more money. But again, if you don't have that, if you have all your money stored in a 529 and then, your kid winds up not going to college, or, whoever else in, any of your kids don't go to college, or they decide to do something different, then you're going to have to move that to someone else. Or if they take it out, then they're going to have to pay the tax on it. So again, when something's so uncertain, it's just coming up with the plan that fits your needs and the college needs of your family.
Yeah, and I think another thing to consider too is just like, well, what order are you saving in? And it's just like a lot of people will be like, oh, well, I should start contributing right now to my 529s. Well, is that at the detriment of getting your match from your employer's 401k? Is that at the detriment of having a emergency fund? Really, like I'd recommend, generally speaking, saving for yourself first. Because here's the thing: it's like you might feel like other people might be like, why aren't you saving in a 529 plan? Well, maybe you will eventually, after you get your emergency fund and make all your contributions to your own retirement account to secure your future. But, you know, when they actually do go to college, you can pay for it directly. You know, you don't have to use a 529 plan. So if you've already saved up a bunch of money, you can actually pull that money out of your own accounts. And like Geraldine's example, I think is a great one, is that by using a Roth account, you know, you can take the money that you've contributed to the Roth account out tax-free, even if you're not in retirement. So as long as it's the contribution amount, you can pull it out and leave the income that has been earning in that Roth account to continue to grow. So there's a lot of options there. And I think really the moral of the story that I take away from this is you need to meet with someone like with Rudy, because you know, someone like that can sit down with you, plan this out, say, okay, like what are your goals? What are you hoping for? Where are you at in your overall financial plan? And tailor it to your own particular needs. Because unfortunately, with planning, there's just not a one answer, one size fits all kind of solution.
Awesome, thank you so much. And there was another question. There was a few that came in, so I'm trying to group them by the same topics. So it looks like someone asked, if your child does not go to college, what happens to that money? So I believe Geraldine answered it, is that you will have the tax liability, right? If they just use it for non-educational expenses, correct? Or you can transfer it to child. So if you have one college fund, right, and they go, you can change the beneficiary to the next oldest child in hopes that they will go.
Right, exactly. Right. Because, you know, the reality is I know my other child's probably not going. So, you know, once he's done and my niece is done, you know, that's it.
Awesome. Thank you so much. Okay. We have a couple of other questions that came in. So the next one is, if you're working with an investment planner, at what point do you begin having conversations with someone with regards to tax planning?
So I'd say that's something that I'm going to refer this question. I'm going to kind of rephrase it. And it's like, you know, when should I have a CPA? When should I have an enrolled agent, somebody like that, to do my tax planning versus using something like TurboTax? And it's like, I think overall for a lot of people who just have W-2 earnings, maybe you're just taking the standard deduction and that's it. You don't necessarily need a tax advisor and pay somebody hundreds of dollars for tax advice. I think a financial planner, I've been through all the courses and took all the tests and everything. I've seen the course, and it's like, I think financial planners can meet the demands of probably well over 80% of the population of people when it comes to tax planning. They can guide people through the process of like, well, here's the best strategy for saving, here's the best account type. Because when it comes to actually preparing your taxes, for a lot of people, it's basically you got a W-2, and you've got certain deductions and you put those on the tax return, and it's that simple. So there's no harm in not having a tax advisor at a certain point in your life. But organically over time, something will happen in your life, or maybe you're a business owner, you become very successful. It's like, you know, your business starts to grow. Well, then you definitely as a business owner want to have a tax advisor, because you're going to be filing business tax returns, you know, employment tax, all this kind of stuff. And then at a certain point where you have a lot more money, perhaps in your brokerage account, that might be the trigger that says, okay, now it's time for me to maybe look at a tax advisor, because now I've got a lot of money in my taxable brokerage account, and the transactions that I do there could impact me. And so I need to have somebody who can help guide me through that process. And I don't see it as like one or the other. I see it as a partnership between someone like Rudy and a CPA working together for your own best interest.
Great. Thank you so much. Geraldine, did you want to add anything, or Rudy, to that?
I was just going to say that, again, I agree. It really goes to your lifestyle. Are you, you know, how busy are you? So sometimes, you know, you may not have the time to actually take care of something. So, or you may not have the time to pay as much attention. So in those cases, I probably would enlist someone sooner than later.
And I think, like Hayden said, it's a team approach to look at your financial team. So there's times where I'll work with the client's financial CPA, because sometimes when we explain certain things to clients, like how you tell a story, the game where, by the time you tell the story to one person, by the time it gets around the next 10 person, the whole story is changed. So it's kind of like myself and the tax advisor could actually speak the same language and said, okay, we have X amount of embedded gains within the portfolio. What is the maximum capital gains that we can take, which will not throw them in another tax bracket, a tax penalty? So we could actually work that out, and the client may not understand it, but the CPA and myself would say, okay, well, 20,000 is the most that we could probably do would not throw them in another tax bracket. So I think it's just looking at your overall financial team, not just, okay, I have my planner here at Schwab, I have my attorney. A lot of times when you start gathering assets, we want to bring everybody to the table so we all know what's actually going on with your overall financial plan. Because we talked about in the beginnings, Kimberly, the holistic, the comprehensive financial plan, not just the investment side. Talk about estates, talk about taxes and everything like that.
Absolutely. I always look at it like your medical team, right? You have your general practice doctor and you have your specialist, and they have to communicate with one another. So same situation here. Okay, next question is along the same lines, and then I'll move on to a different question that's kind of a different topic. But someone asked, what are your thoughts on when to move from automated investing with professional guidance to having a singular advisor? And I think you all kind of hit on it, right? To have that team in place. But when would you move from automated to having a singular advisor? The time of robo advisors are popular.
Yet again, there's really no right or wrong. I think it really depends on the preference for the investor, because if you think about the robo advisors, it's efficient and it's cost effective. So if fee is one of your main driver, the robo advisor may be a better option for you. But then once you start getting more assets, it becomes a little bit more complicated. And like Hayden says, there's tax ramifications. So when you have the robo-advisor automatically adjusts the portfolio to keep it in line, whether it's 80-20, 60-40, and it doesn't care about taxes. Where now, if you want to start looking at taxes, you want to talk to the advisor and say, okay, let's see where we could, tax harvest some losses. Okay, yeah, we are a little bit overweight on the equity side, but because of your tax situation and the capital gains tax you may pay, we will keep that tilted a little bit more and wait until maybe next year and take profits and peel that back. Or maybe there may be another loss, or do you have any carryover losses that could actually offset that? And it's just that customizable approach, I think, what that individual investor has. Some people like suits that's right off the rack. Others like a custom suit, a tailored suit where it fits them well. And it just depends on how willing are you willing to pay for that service that you need.
Awesome, thank you. Next question. I invested in sports cards as a kid. That investment has grown. Should I cash out or hold for retirement? I'm 45 years old. So we have a collector here.
It kind of depends on, what your goals are. I mean, it's like, and how much those cards are worth. I mean, some of those, I never collected cards, but I've heard some stories that are impressive about what some of those things can be worth. In the end, it's like, I don't see personally any problem having a portfolio diversified in the real estate, into trading cards, into gold, and, all those kind of play together and they create a form of diversification. So really, it does come down to your own particular goal as to, like, do you have a specific purpose that you want that money for, or do you want to transition that money into equities or something like that? I don't think there's any per se right, wrong answer when it comes to that.
Yeah, I have no additional comments. I agree. Sometimes too, there's intrinsic value to the person. Maybe they don't want to let go of those cards, or maybe that, this particular card is selling for a lot of money. Maybe divest that card, but this one that's special and you had since you were 10, you want to keep. So I think there's a lot of different elements there.
Thank you. Okay, and this question is specifically for Geraldine. When you were talking about your saving for your niece, the question is, who controls the account? Do you or her parents?
So I control the account. I told my sister that I was going to be saving for, for her college. I did get the information I needed to set up the 529. I set it up online, and it's my login. But they do know that I am putting away money for her.
And I think the good thing about the 529 plans is that, if you set it up, anyone can contribute to it, right? Because I have one also, that I have for my goddaughter, 3, when her very first Christmas, I told her mother I was going to set it up for her. And so every Christmas, I send out the links, like she has her own link that people can go in and contribute to it. And, so it's not just the person who sets it up that can contribute, anyone can do so. So that's good. Okay, next question. All right. I knew this question was going to come, told you. While many of us may not be immediately impacted by the anticipated change in capital gains tax, how do you see this directly impacting your type of clientele and potentially indirectly impacting the market as a whole? So we've all been hearing about this new capital gains tax is going to go up for some people. I wish I was in that category, but
yeah, I don't have those kind of problems personally.
Yeah. So I mean,
about, really what the talk is about, what the buzz is about, so everyone who has not been following can understand who that could potentially impact, and then the answer to that.
So one of the things that's kind of difficult about this is we don't know a lot. This is just a proposal from the president. The president doesn't write the tax law, Congress does. So all he can really do is make firmly worded suggestions to Congress and see what they do. Really the problem too is we don't actually understand how the intricacies of how it's going to work, because the way it's going to work is most likely is going to work is that let's say you have no income other than capital gains. What would probably happen is that you'd have, from 0 to about $19,000 will be taxed at the 0% capital gains tax rate. From 19,000 to about 450,000, if you're a married couple, is taxed at the 15% tax rate for capital gains. And then from there on up, traditionally, it was 20% from there on up. But what this proposal seems to be saying is that, like, from that $400,000 mark up to the million, that'll be 20%. But once you break over $1 million, then that next dollar becomes taxed at your ordinary income tax rate, which Biden is proposing would be 39.6%. And so that's where, from there on, that's what the tax rate would be. And again, we won't know for sure exactly how this is going to be implemented until we see some actual legislation come from Congress itself. But yeah, it could have some impacts on the market, and we've been thinking about that as to well, what does that mean? Because if I was a person in that situation, and I'm like, okay, if I sell anything more, it's going to push me up into this really high tax bracket. Maybe I'm not going to sell as much. So it's maybe people hold their assets longer. Or what could happen is if they do pass something, say in the next few months, we could see a ton of selling from investors trying to sell the assets this year so that they get it at the lower capital gains tax bracket for 2020 and increase their cost basis on it. And so there could be the market could see a dip because, boom, people are selling. And then all of a sudden those people start buying back again after they've increased their cost basis, and the market could take off again. I think those are going to be all kind of what I've seen from research perspective is that people tend to, it's like the pendulum swinging. They overreact when they see new tax legislation, and then they come back to an equilibrium point. And I think what's going to happen is if there's something passed, we'll probably see in the first 3 to 6 months, people overreacting to it. And then eventually people will realize, okay, it's not as big a deal as we thought it was, and things will kind of go back to norm after that.
And I echo the sentiments what Hayden says, and I think, you know, talking to clients with that in regards to that, you know, capital gains, what should we do? You know, we boil it right back down to the financial plan. What is the big picture? Where do we want to go with the portfolio? And don't allow the taxes that you need to pay to actually disrupt what your overall goal is. If you want to take profits, and we'll deal with the taxes as they come. Because the last thing we want to do, I tell clients this all the time, either we take profits on the stock or the market takes profits for us, and we may not like it. So you may have a gain of $10,000, but I don't want to pay taxes. I don't want to take taxes. The market goes the other way. That $10,000 gain now is a $5,000 loss. But you were trying to avoid taxes. Let's stay focused on the long-term goal of the plan, and then what we'll do, we'll strategize. Like Hayden says, this is all subjective in the sense of what the president wants to do. The market pulled back last Thursday because President Biden said he was going to raise capital gain taxes. But we all knew that he was going to raise taxes because that's what he talked about on the campaign trail. So it was nothing new. So the market pulled back on a knee-jerk reaction, and then Friday it bounced back up because everyone's like, yeah, that's what he said he was going to do anyway. So it's limiting the noise, all that noise that we get from the media, because the media, when you look at the media is there to keep you locked in to sell ads. They're looking at a short term. When we're looking at your portfolio, we build a plan, we're looking at 10, 20, 30 years out. So that little blip that you look at in the sense of, oh, the market pulled back, it's just going to be a little, you know, dot when you look at, you know, a minor drop when we look at 20 years out. It's just like when we looked at, you know, back in the financial meltdown happened. You know, everyone sold out of the market and was concerned there. Oh my goodness, oh my goodness. And what happened? They never got back in. The individuals that stayed the course, stayed focused on their long-term goals, were handsomely rewarded because they kept true to their plan.
Absolutely. Thank you so much. And I wholeheartedly agree with that. It's like, we know what administrations are going to do, right? Whether it's, you know, the right or the left, we know where money is going to be shifted when administrations change. So, okay. The next question has to deal with Roth IRAs. So someone wants to know, can you explain what a backdoor Roth contribution is? I think Geraldine, you had talked about that a little bit.
Yeah, sure. So, you know, for Roth, I'm not sure if everybody's aware, for Roth, you know, there are certain thresholds, income thresholds, to actually be able to contribute to it. So once you exceed that threshold, you try to think about, okay, how am I going to be able to get money into a Roth? And what a planning technique and a technique that some people do is they will take an IRA. So, you know, again, if you're at that income threshold that exceeds the Roth contribution, you know, you're probably right around that threshold or exceeding the threshold to actually be able to deduct your traditional IRA. So even though you can make a contribution to a traditional IRA, that contribution is going to be after tax. And again, you can't deduct it. So what a backdoor Roth is what people will do is they will take that contribution they made to that traditional IRA, because they would still be eligible to make a non-deductible contribution. And then what they'll do is that they will actually convert it over to a Roth IRA. And that is a way for someone who is, again, above the income threshold to actually get money into a Roth IRA. And then once it's in that Roth IRA, it will grow tax-free until you meet a triggering event and have held it for 5 years. So hopefully that's helpful.
Would anyone else like to add to that?
Yeah, I think like the only thing that you will need to be careful of when it comes to that Roth conversion is that if you have any other IRA accounts, there's this rule called the pro rata rule. And basically it says you can't roll over just one account. You got to look at all your accounts and determine what portion you're rolling over is taxable and is not taxable. And so some people get caught by that. They don't realize that it's like, oh, you know, I can just roll over this one account and it's not a big deal. It's like, no, if you've got other tax deferred accounts, like other IRAs and sub IRAs and things of that nature, you need to plan that out. And again, that's where I think talking with an advisor just to kind of like go over the idea, before you actually initiate it is a big deal. Because I actually had a client come to me one time, and this is it's a simple story. I mean, they had one IRA account, but it had $750,000 in it. And this individual said, I want to do a Roth conversion. I'm going to take all that money, turn it into a Roth, because I read this article in the New York Times that said that's a really good idea. And I was like, please stop, don't do that. If you do that and you live in a state with a very high tax rate, you will pay probably a 50% tax on that based on your current income level and what you're rolling over. And it is going to take years for you to get back that tax, because you got to have years for that money to grow in the Roth account. So what I ended up advising that person to do is like, let's do it in stages. You know, let's target a specific tax rate where we're going to go up to this tax rate to do the Roth conversion. Each year we'll convert a little bit more, but let's not like do the whole thing at once. Because the tax impact would be brutal. You know, like you got 39, at the time it was 39.6% tax rate for ordinary income. And then they had like, I believe it was like a 9% tax rate at the state level. So it would have been massive impact to their overall financial plans had they done that. And that's where I think working with an advisor, they can kind of throw off some ideas, see which one works best for you. And again, there's no right or wrong answer per se. Sometimes I think there was in that situation, it's like that was the wrong answer. But the right answer was like, hey, we can still do it. Let's just strategize it a little bit more.
Awesome, thank you so much. So there's another question that goes back to custodial accounts. Can those be set up for kids other than our own children, similar to 529 plans?
Yes.
Thank you. Short and sweet. Okay, so we are down to the last 7 minutes, you guys. It is 7:08. So please, if there are any other questions, please do raise your hand if you want to verbalize it or put it in the chat box. So that way we can get it answered, get as many answered in the next couple of minutes so we can be respectful of your time this evening. So another question, in your opinion, what is the most valuable question or questions to ask when searching for a financial advisor? Go to Schwab, right? That's the first answer, but go ahead. What are the questions?
Well,
I think
go ahead,
Hayden.
No, go ahead. Rudy.
I think that the key when you look for a financial advisor, yes, is experience, the credentials, the licensing. I think the firm has a big impact on the advisor. If you look at Charles Schwab, Schwab's brand recognition, the quality of individuals that they hire at Schwab, the culture says a lot. And with Schwab, how we work at advisors, we have a lot of resources. So you're not going to have me recommending something that's totally different than Christine. We all have the same toolbox, but we use different tools to get the same goal. And I think that's one of the critical things, is finding a firm that's reputable and have good quality advisors. And I think the other thing is the personality. I think that's critical in the sense of, I know the type of clients that work well with me. Other clients were like oil and water. Oil and water. But I think that's critical in the sense of advisor where you feel comfortable opening up and sharing your deepest and most treasured goals and what you're looking to accomplish. Because if you hold anything back from me, I can't help you achieve your goal. Sometimes I joke around and I tell people, sometimes I feel like I'm a psychologist in the sense of trying to save people from jumping off the ledge, in the sense that they call me, hey, Rudy, I want to sell everything right now. The market's down. Oh, let's take a step back. Okay, what's going on? Well, this is going on that. Okay, let's dissect it. Okay, how long are you looking to retire? Well, I'm looking to retire in 10 years. Okay. So now we take a step back and help get them to refocus. But I think the key is, find a firm that has, reputable advisors, look at the credentials, everything like that, but also being comfortable working with that advisor in a sense of a relationship, so you could actually share, because it is a relationship. I tell clients this all the time. It's like dating. We have a first meeting. Yeah, what do you like? What investments don't you like? How many times do you want me to call you? Do you prefer emails? Do you prefer phone calls? Okay, then we start, finding out each other's hot buttons and what get warm and fuzzy. And then between, you know, a year, then we're best buds. How's the wife? How's the kids? I heard you got a dog. And then it's a great conversation. And it goes from being just a business relationship saying, well, Hayden, tell me about your goals. Well, the market's up, to, hey, your daughter got married. You know, how was the wedding? And they're sending you pictures and they're, you know, they're asking you little different things. Hey, I'm looking to buy a car. What do you think about this? So I think that's one of the critical things, that relationship piece of it.
Well, I have nothing to add to that. That was an excellent.
Well, since
Yeah.
we're talking about financial advisor list, you know, I know you mentioned having, you know, the team, right? So, you know, let's talk about your CPA. I'm assuming some of those questions would be the same. And then next week we'll get into estate planning. So of course, having that attorney. So are there any other kind of questions that need to be asked? Sorry, Geraldine, you can go ahead.
No, Rudy just said things so well. Yeah, no, I didn't have anything to add. Yeah, there are just so many things that you can, there's just so many different aspects of getting that team. And for you too, it's also, you know, what is it that you're looking for? What do you need? Do you need investment? Is it tax? I mean, it's great to have that big team, but at the same time, some people can get overwhelmed. And I think starting, you know, just like Rudy said, starting off, you know, where you feel most comfortable and then going from there.
Awesome. So I think that is it. Oh, we have one more. So we'll close out with this one. So I will give each of the panelists final words. If there's anything that you would like to add that maybe that wasn't talked about as far as investment planning, educational planning, tax planning. And then the final question is, what books do you recommend we read to become more knowledgeable? So if you can throw out one or two of your favorites in that commentary, that would be great. So we will start with ladies first. So Geraldine, then we'll hit Rudy, then we'll hit Hayden. Final words, what book? And then I'll also allow if there are any guests that would like to, you know, throw out a book or two that they've read, and then we'll close out with that. So go ahead, Geraldine.
I wouldn't say books. I'm not a big book. I listen to audiobooks. That's about it. So I would say I read a lot of things. Natalie Choate is an author. I'll read a lot of things. Ed Slott, sometimes I'll read things. So I read things really from everything, you name it. If it's financial, I'll read it. But those are two of the two article writers that I do look to a lot.
I would say a book I would recommend reading. I like the book of The Richest Man in Babylon. It's interesting. It's more of a, I don't know, like one of those old, I can't forget how it is, but it talks about a guy that's trying to get rich, and there's different steps in the sense of how to become wealthy. And he talks about stories about, you know, if you want to be wealthy or if you want to get rich, go to the experts. And I think it boils down what we talked about earlier, Kimberly, in the sense of hearing about Bitcoin or hearing about Forex trading, and you're hearing it from someone that's totally not in the business. If you have questions, go to a professional and find out the details behind, that particular investing. I knew, like back in 2000, when we had the .com bubble actually happen, I had a plumber come to my house, and I try not to get in the conversation too much about finances because I try to disconnect when I was home. And he asked me about investing, and he's like, I have this company, you should buy pinkmonkey.com. And I'm like, here's a plumber. Your trade is to be, to fix pipes, and you're great. Now you're giving me stock tips. So if I would have taken that advice to buy pinkmonkey.com, my money would have blown up in smoke. So it's in the sense of looking to the experts for what you're looking for. It's if I want to get my heart operated on, I go to a cardiologist. I'm not going to go to the guy around the corner and say, hey, what should I do? Should I take these pills or whatever? You go to the experts. So The Richest Man in Babylon has some great nuggets in the sense of overall how to generate wealth overall, not only in investing.
Thank you, Rudy. And last but not least, Hayden.
So a book that I really like, I just recently read it. It's called The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. It's a pretty short book, actually. The guy does a great job of just like talking about finance in more of a practical application way, rather than like, you know, like saying, oh, every decision you make should be out of a spreadsheet. It's more like making you feel good that it's like, yeah, you can use your own practical understanding of the world, and you can use your gut feel, and you can know, like Rudy said, like, you know, if you can't sleep at night, that's a good sign your risk tolerance is a little high. And it talks about different things like that that can help you lead to making better decisions throughout your life. It's definitely helped me, you know, quantify some of my decision making a little bit better. And then another book that is, I think it's more entertaining than it is about finance. And in a sense, it's written by a guy who used to be a bond trader on the floor at the New York Stock Exchange, I believe it was, or it was a Chicago Mercantile Exchange, who made tons of money, eventually left the market, became a neuroscientist, and wrote about like the effects of like our own physiology on how we invest and how we react when we're afraid or when our risk is too high. And he kind of tells a great story of like how this applies to us as everyday individuals, and how it can impact our decision making if we're not aware of how these decisions affect our own physiology. So that one's just kind of more of a fun book. It's called The Hour Between Dog and Wolf: Risk-Taking, Gut Feels, and the Biology of Boom and Bust.
Okay, that's a long one.
Yeah. It was a fun book though. I listen to audiobooks too. I tell people I'm illiterate. I don't read. I only listen to audiobooks. I just don't have the patience to like sit there and like read a book for hours. It's like I like to do like lawn work or like ride my bike and listen to them.
Awesome. Well, thank you all so much. It looks like, do we have anyone in the audience that would like to share a book? I think we have one that came in the chat box. Hugh Perry, would you like to take a couple seconds just to talk about the book that you had mentioned? We'd like to give our guests an opportunity to speak. I think he's on mute.
I don't know if, can everybody hear me now?
Yes, we can. Would you like to share your recommendation?
Yeah, the book, I'll quickly recommend.
I'm sorry, you're a little low. We can't hear you. Okay. Yeah.
Can you hear me any better now?
Yes, we can hear you now. Go
All
ahead.
right, I can hear, but as long as everybody can hear me, that's fine. The book that I highly recommend is The Millionaire Next Door. Fortunately enough for me, I read it straight out of college, and it's been kind of my blueprint. And I just tell everybody, just give that book a read. It takes you, avid reader, a couple hours to read, but it's a very basic, holistic view of finances, and it's simple. Come up with a plan, reduce your debt, and follow your budget. And it has really helped for me. And I share it with a lot of groups. I don't know if anybody else here has heard of the FIRE movement, Financially Independent, Retire Early. There's a whole grassroots movement of people on the internet, and I'm active. I'm very active in that group. But you know, I'll tell people, and sorry to take up too much time, but I have a special affinity for this group here because I'll share a quick story. National Black MBA had a conference in Orlando, and I'm in Jacksonville, and I ended up not coming to the conference, and I got 2 calls for interviews from that conference, and I ended up taking one of those jobs with CSX, the railroad. I turned down Target, didn't want to move to Minneapolis where it's cold, but I tell people this story that I didn't come to the conference, and just my name and my resume being registered to that conference, I got 2 calls for interview, and one turned out to be a great career. But again, my small tidbit, I appreciate Geraldine, Rudy, and Hardin giving, they're professionals, and I tell people, there's always good to talk to professionals, but for your own knowledge, you need to have a basic understanding of personal finance. And a book like The Millionaire Next Door talks about debt and talks about having a disciplined saving strategy. And I've built my wealth S&P 500. When people come and talk to me, I say, it's simple. S&P 500, I've been doing that for 25 years. 2008, when everybody was selling, I kept on buying. And same thing last year, when everybody was selling, I kept on buying. Yes, if you want to do crypto or something innovative, you can do it, but don't make it be anything more than 5% of your entire portfolio. But again, I won't take up too many people's time. I just wanted to pass this on to the group. I sing high praises about this group to all the other groups that I'm in. So whenever I get a chance, I just wanted to let you all know my story and my experience. And if anybody wants to reach me, I'm Hugh Perry on LinkedIn, and I'm also HAPEIT on Twitter. I'll put it in the group. You'll see me post a lot of fire articles and fire information on my Twitter. That's all my Twitter is about, is fire.
Thank you so much, Hugh, for that information and sharing with us. All right, so we are done for the evening. We are 2 for 2. We have one more component, and next week, join us. If you have not registered for next week's event, please welcome to use the same link for part 3, and we will be covering retirement income planning. We will welcome Hayden back with us for that panel. And then we will also have estate planning, where we will have an estate planning attorney that will join us for that. And then of course, all the other panelists, they're welcome to join us